afternoon, everyone. Welcome to our March edition of NITYA Round-Up. Before we start our session, there is a good news on being environment friendly. So Supreme Court has allowed use of OE4 sheets with double-sided printing. So starting from the Apex Code, there's a lot of concern on caring for the environment. So in today's roundup, we'll be covering upcoming disputes, what are the major challenges all of you are facing, the legal precedents, recently starting from tribunals till Supreme Court, some important judgments have come up which will have bearing on your business. Year-end to-dos as we are coming to end of financial year 1920. So there are some to-dos from GST perspective which you need to make note of it. Upcoming changes, 31st March 2020 is a very important date. There are a lot of changes which are coming up on indirect tax front, be it GST or customs and foreign trade policy. And lastly, we'll cover some news snippets, the things which are in news. Our today's session will be taken by me and my colleague Rohit, who is an associate in the firm. So starting with upcoming disputes. So we'll start upcoming dispute section with a poll. So we are launching a poll. You'll be able to see in your front. So have you received any communication from department to pay interest on delayed payment of GST? So all of you would have read in newspaper that as per government's estimates, some 46,000 crores of interest is unpaid due to delayed payment of GST, and there are auto-generated mails which many of the taxpayers are getting. So have you received any such communication from department? So there are two options for you, yes and no. We'll wait for 20 seconds. Please use a poll button to exercise your option. See, the purpose of this poll is that all of us get a perspective as to what sort of disputes which are arising, what is our take. So please use the poll button. Have you received any communications from department for delayed payment of GST, asking interest on that? You can use yes or no as the option. So we are closing the poll now, and we'll be putting the results in front of you. So 60% of today's audience, they have got such notices where interest has been demanded. So we'll come to the issue now. So recently there was a Madras High Court judgment in case of Reflex Industries. In that case, the major issue was whether interest liability will be on gross tax or net tax. Here we refer to gross tax means a gross output tax liability you have to pay, and net tax means after setting off the ITC. So the issue before the High Court was whether interest is applicable on gross or net amount. The High Court duly noted that the proviso has been inserted in section 50 to correct this anomaly. The High Court held that it should be interpreted as a clarificatory amendment and therefore will have a retrospective effect. High Court also noted that in such cases the department need not issue any show cause notice and there can be a direct recovery from the taxpayer. So in this case, one of the important aspects which the High Court has missed is that this amendment, the proviso to section 50, this amendment has not yet been notified. Therefore, this proviso does not form part of the statute as on date. So to that extent, based on an anticipated amendment, this may be correct, but as the law stands now, the ruling of the High Court stating that the proviso has been issued to correct an anomaly and has a retrospective effect, to that aspect, the High Court ruling is incorrect. We have a GST Council meeting tomorrow on 14th March. So this is one of the important topic which is there in the council's agenda. So let's hope that the government notifies this amendment, and if the notification comes up, it is likely to be prospective from government side, but yes, based on Reflex industry judgment, it can be considered to have a retrospective effect. So the way forward, we feel that if the law is correctly interpreted, the liability should be on, the interest should be applicable on the gross liability. The reason is the input tax credit is a right which is granted to you. You may take or you may not take input tax credit benefit, but as far as tax liability is concerned, that's a gross amount which you are required to pay. To that extent, the liability of interest should be on gross amount only. The government has given options to you. You can pay the tax in cash or through credit. So to that extent, in our view, based on today's legal position, the interest liability should be there on the gross amount only. As we discussed, that amendment has not yet been made effective, so it will not have any bearing on the issue. There's one more independent argument which can be taken, in fact, which will not only take care of net liability, which can take care of gross liability, is that Section 49 of the CGST Act deals with the payment of taxes, interest, etc. The interest liability triggers only if there is a delay in payment beyond the prescribed period. But surprisingly, neither under Section 49 nor with the corresponding rules, any period has been prescribed. So on this basis itself, the interest liability can be contested. Another important point is that the taxpayers can also take this matter to the court seeking an equitable relief, because today the way GST portal works is either you have to pay full tax or you cannot pay tax at all. So the government has not provided any option to pay part of the tax. So if I have a liability of 180 rupees ITCs lying with me, I cannot set it off 80 rupees on the due date, and I can do that only when I have 20 rupees cash also. So to that extent, the present provisions are inequitable. Lastly, interest is also a recovery which government is sought to be making from a taxpayer. Any recovery which government wants to make, it cannot make straight away. It has to firstly issue a show cause notice. The taxpayer will file a reply. It will be adjudicated. Once either at Commissioner Appeals, Tribunal, High Court or Supreme Court level the matter attains finality, then only the question of recovery arises. So to that extent also the Reflex industry's judgment is incorrect, where it said that the recovery can be made directly. So in nutshell, in our view, interest, as the provisions stand today, interest is payable on gross amount only, but there are independent arguments, there being no prescribed period because of which interest is not payable. Then on the grounds of equity, it can be contested. And lastly, the government is mandatorily required to follow the statutory procedure of issuance of show cause notice, etc. The second poll which we are running is we have this 10% restriction under Rule 36A. So many of the taxpayers are receiving auto-generated mails that they have not complied with the ITC availment limit of 10%. So the next poll we are running is, have you received any such mails for violation of ITC availment restriction? So we are launching the poll now. You have two options, yes or no. We'll wait for 20 seconds, and the poll is in front of you. So please exercise your options. So this provision is also likely to trigger a lot of disputes because lakhs of such mails have been generated where no basis, etc., has been sent. So please exercise your option. We'll wait for another 10 seconds and then we'll close this poll. Yeah, so we are closing the poll now, and we are putting the results in front of you. So 52% of the participants have received such auto-generated mails. Now, proceeding further on the slides. So what this restriction is about? So there is a supplier and the supplier does not upload its invoices, etc. So whether ITC on such documents is available. So as far as the recipient is concerned, the government has allowed credit with a 10% buffer. So if the documents uploaded are for credit of 100 rupees, he can take credit of 110 as per GSTR 2A. So Rule 36 provides that ITC on invoices and debit notes not uploaded by supplier in GSTR 1 will not be available to the extent of 10% limit. This is applicable on all invoices and debit notes and not applicable on ISD invoices, import of goods, and RCM procurements. So coming to the issue now, as we discussed that everyone is getting an auto-generated email that this restriction or this limit has been breached, and the mail only says that this much credit you have to reverse. So in our view, there are multiple reasons for which these demands, etc., are not sustainable. The first being whether this restriction is valid at first place or not, because the constitutionality of this provision is being challenged in multiple high courts, Delhi or Gujarat. So the legality of this provision itself can be challenged. Importantly, these emails do not contain any basis. Just a blanket figure is given that this much credit has to be reversed. These emails do not follow statutory prescribed procedure of document identity number, which is DIN. So there are multiple reasons for which these demands are not sustainable and the taxpayers can contest it. So the practical way is that firstly, you should write a simple letter or an email to the authority seeking basis for that. And then only the question of whether violation has happened or legally challenging that arises. So third poll and last poll for today is that are you aware about Rule 86A? So this provision deals with blocking of ITC by government. So many of the taxpayers are facing situations where their ITC is blocked at back end by tax officers. So this poll is, are you aware about this? Have you faced such situations where ITC has been blocked? So two options are yes and no. So we'll wait for 20 seconds and please exercise your option that whether you have heard of blockage of ITC by government or have you faced such issues or not. So we'll wait for another 5 seconds and we'll close the poll now. So you will be able to see the results. So 64% of the participants have not heard about it. And yes, it's not a great thing that you should have heard. It's a derogatory provision from the government side only. So there were news clippings also that the central government has issued internal instructions to block ITC. So what is happening is that under GST law, like we were discussing in context of interest, that if government has to make any demand, firstly they should issue a show cause notice, give an opportunity to file a reply, conduct a hearing and then adjudicate. And then if taxpayer does not agree, he go in further appeals, etc. So that's an adjudication procedure prescribed in all the tax laws. But in GST law, the government gave power to tax officers that if the credit has been fraudulently availed, then the credit can be blocked. So this is meant to cover cases like where supplier or recipient are non-existent, where recipient is not in possession of tax invoice, where tax has not been paid by supplier. So these were extreme situations where this power had been granted to the department, where they can block the ITC. But practically what is happening is that ITC is being blocked without any communication, without giving any reasons. So in our view, such blocking is unconstitutional because principles of natural justice are not being followed, neither any notice is being given, nor any opportunity of being heard is being given to the taxpayers. So if any of you come across such situations, you should legally challenge such action from the department's end. Coming to our next section on precedents, so we'll be covering some important legal precedents in last few weeks on indirect tax side. Starting with the Supreme Court, there were a lot of disputes on transitional credit, how pre-GST taxes were credited to GST regime. We had a famous ruling in case of Adref Technologies where they held that substantive benefit of transitional credit cannot be denied for procedural lapses. So the revenue filed SLP before the Supreme Court, and the Supreme Court did not admitted revenues SLP. Very importantly, that in terms of constitution, non-admission of SLP is not a declaration of law by Supreme Court. So we have been reading in newspapers and columns, etc., of people stating that Adref technologies have been affirmed by Supreme Court. It is not so. An SLP was filed which has not been admitted. So as per Constitution of India, this is not a declaration of law by Supreme Court. So the only meaning is that the High Court ruling stays intact. Just very near to when this Adref technologies happened, there was another matter in case of Lantac Pharma, which went to Supreme Court, where the taxpayer could not file Tran 1 due to technical glitches, and the High Court directed authorities to reopen or permit manual filing. So High Court allowed taxpayers petition. Against that, the matter has been filed in Supreme Court, and Supreme Court has admitted. So the purpose of highlighting this is that these Tran 1 disputes have not yet been settled. So the Supreme Court in cases have been admitting, and the matter is likely to attain finality by Supreme Court only in times to come. Coming to some important High Court judgments, service tax on notice pay, and this is equally relevant in GST regime as well. So in case of GTND, the Madras High Court held that if the employer facilitates exit of an employee upon imposition of cost like a 1 month salary, etc., that is not a service. So this is a very important ruling on declared service which used to exist in service tax regime or even in GST, that such damages, penalties, etc., which are imposed, these do not qualify as toleration of an act which department is seeking to apply in every situation. And this ruling will have equal relevance for all sorts of penalties and liquidated damages which are being imposed. A very important Delhi High Court judgment which has come is on the budgetary support scheme. So just to give a background, that we had area-based excise exemption schemes in Uttaranchal, Himachal, J&K and Northeast, in which either the government has granted full exemption of excise duty or a part of excise duty which was paid was refunded. These schemes were in vogue till implementation of GST. With GST coming in, because the validity period of these schemes had not expired, therefore the government brought a new scheme, which was a budgetary support scheme, in which 58% of CGST or 29% of IGST was granted as refund. But as compared to earlier excise duty exemption, the benefit of budgetary support was on a significantly lower side. So in case of Hero MotoCorp, the taxpayer challenged the budgetary support scheme before Delhi High Court. The taxpayer contended that my benefit has significantly reduced. He sought to invoke doctrine of promissory estoppel to contend that my original benefit should be restored and I should get a higher amount of refund under budgetary support scheme. But the High Court did not agree with the taxpayer's contention. The High Court held that the taxpayer does not have a vested right for budgetary support of GST amounts. The notification 50 by 2003, which was granting excise duty exemption in Uttaranchal, had lost its relevance post introduction of GST. The High Court also specifically held that promissory estoppel is not enforceable in view of Section 174(2)(c of CGST Act, which specifically prohibits it. So in our view, there are two important aspects which we need to note. One, on the promissory estoppel, in our view, this judgment is incorrect because once the government had promised that excise duty exemption will be available for 10 years, therefore it was incumbent on government to grant this benefit even if it's changing the whole landscape of indirect taxes. Secondly, one thing we felt that which could have been put up to the court was that what was the exact quantum of benefit which was available pre-GST versus what is available in budgetary support. So maybe if the quantification would have been put, it would have made a difference. But yes, at a conceptual level, we feel that this ruling is incorrect. Proceeding further, as you're aware that post introduction of GST, there were 4 months where IGST exemption was not granted and it was to be paid in cash. So in this case, the taxpayer imported capital goods under EPCG scheme prior to 13th March, because after this date, EPCG exemption was restored. The High Court held that this notification will be considered to give a retrospective effect and allowed refund of GST paid in cash. Another important judgment which has come up in respect of VATs is that in this case, the dealer received discounts from the manufacturer. So say for example, a car dealer, he has purchased car from Maruti. Subsequently, due to various discount schemes, etc., floated by Maruti, he has got a purchase discount. So the VAT authority sought to include it in his sale price and levy VAT. So the High Court held that discounts offered by manufacturer to dealer are not includable in the taxable turnover. In our view, this Madras High Court judgment is an important judgment because similar disputes are arising in respect of GST regime as well. The government issued one circular, then withdrew that circular. And at a ground level, many of these dealers or consumer durable or car companies are facing such litigations. Another controversy which was artificially created by advanced ruling authorities was that Section 97(2)(e) of the CGST Act says that advanced ruling authority can also be given on issues of determination of liability to pay tax on goods or services. Despite this clause, many of AR were taking the view that place of supply issues are not covered in this. In our view, this clause is wide enough to cover such cases. So recently, Kerala High Court, in case of Sutherland, has clearly held that advanced ruling authority has place of supply issues in its domain and should entertain them. Coming to the tribunal judgment, In our last webinar, we covered the issue of AMP, which is advertising, marketing, and promotion. So many of the multinational companies or Indian distributors, especially in consumer goods side, they are facing a dispute with the custom authorities, wherein the custom authorities are contending that whatever advertisement, marketing, or promotion spend is done by the Indian company or Indian distributor, that is done on behalf of the foreign company or the supplier, and it constitutes to be and it is addable in the assessable value of the goods. So two important rulings which have come up recently, one in the case of Indo Rubber, in which the tribunal noted that the agreement between the exporter-importer does not bind importer to incur particular amount or particular percentage on AMP activities. He incurs expenses on his own account, and therefore they ruled out the applicability of Rule 10(1)(e) of the valuation rules. And on similar lines has been the recent judgment in case of Adidas marketing, where identical verdict has come. So these two judgments are very positive, especially for the importers community if they are facing dispute on AMP side. Important tribunal judgment relevant in GST regime. So this was a case where post introduction of GST, the taxpayer paid CVD and SAT due to non-fulfillment of export obligation under advance authorization scheme. He sought to claim refund. This refund has been rejected on the ground that there is no statutory provision. This judgment has come in case of servo packaging. In our view, legally this judgment is incorrect, and this is contrary to two other judgments, including one High Court judgment in case of Thermax. Another important judgment which has come up in respect of a FTWZ. So in this case, a taxpayer was a unit in free trade warehousing zone. The taxpayer was providing storage and warehousing services to various clients located outside India. So even though the place of supply of such services happened to be in India, the taxpayer contended that my services qualify as export under SEZ law. SEZ law nowhere refers to place of supply rules, etc. And the tribunal accepted taxpayers' contention and held that such services will qualify as export of service and no service tax is payable. Though this is a favorable judgment, in our view, technically this judgment is incorrect because there was no inconsistency between SEZ law and place of supply rules. If under service tax law, government has clearly provided that place of supply rules will determine where services are provided, that should be contextually read in SEZ law as well. Lot of disputes are happening on e-way bill side where some procedural errors, etc. happen. So in the recent past, 3 GST appellate authority judgments have come where they have condoned such issues and imposed a nominal penalty. In case of Godrej Consumer, the validity period was miscalculated. Penalty of mere 500 has been imposed. In case of Bhushan Power, the e-way bill lapsed. Penalty of only 1,000 rupees has been imposed. And in case of Neva Plantation, capital goods were sent for repair without generation of e-way bill, and a penalty of 10,000 rupees has been imposed. So these are very important rulings because practically at ground level, many of taxpayers are facing these issues that the vehicles are intercepted, detained, etc. Huge penalties, liabilities are imposed. So these are favorable rulings, and you should contest wherever such orders are passed before the appellate authority. So the last judgment which we'll be covering in precedents is NCLT judgment, which has come in respect of GST law. So in this case, insolvency proceedings were taking place and the company was bought by some other person. So post buying the company, he undertook all the compliances. But again, the way GST portal works, it requires you to pay all old liabilities before you file future returns, etc. So NCLT held that directed GST authorities that they should not cancel the GST registration of the taxpayer. It restored e-way bill generation facility and allowed manual filing of returns. So this is also a positive judgment. This ruling came in case of Vidicon Group, that if any company is going through insolvency proceedings and it has been bought by some buyer, then at least going forward only the buyer is responsible to undertake compliances and pay taxes. We move to our next section, year-end to-dos. So my colleague Rohit will take the session here onwards. Over to you.
Thank you, Puneet, for explaining the recent dispute and the recent ruling which have come in the past for the taxpayers. So moving on to the next section for the for our webinar, year-end to-dos. So as you are aware that we are approaching the end of the financial year 1920. So following are few things which a taxpayer needs to ensure. First is renewal of LUT for the financial year 2020-21. So the taxpayers who are engaged in export of goods and services, for them it is essential to renew the LUT for next financial year. Next is starting a new series of the statutory documents. So statutory documents as provided in the GST law are tax invoice, delivery challan, debit notes and credit notes. So from new financial year, the new series will start. Third is the most important thing. So few people are aware that they are required to reverse credit under Rule 42 and 43 with respect to the common inward supplies of goods and services. So taxpayers are suggested to ensure that they get the credit reversal done timely to avoid any interest implication. Fourth important thing is issuance of debit note and credit notes by 30th September 2020, because after that you're not allowed to issue any debit note and credit note. And the last but not the least, ITC available by 30th September 2020. So for financial year 1920, the last date to avail ITC is due date of filing return of September 30, 2020. Moving on to the next section of our webinar, upcoming changes. So as you are aware that since 1st April 2020, there are many changes which are coming in the GST. So before moving to the next financial year, it is important that we look that there is a 31st March 2020 is the last date of filing due date of GST annual returns. So although as of now there is no news that whether the date will get extended or not, but it is expected that in tomorrow's meeting GST Council will address this issue. And irrespective of the fact, taxpayers are advised that they check their tax position and prepare the reconciliation statement and avoid any last minute filing to complete this activity. Next important thing which is coming under GST is implementation of e-invoicing, which is expected, which was supposed to be introduced with effect from 1st April 2020 for the taxpayer with turnover having for the taxpayer having turnover of more than 100 crores. So also there are news in the media that this implementation of e-invoicing might get delayed by 3 months, but it is a suggestion that a taxpayer need to ensure that their IT system are very well ready, their employees are trained, and their vendors and customers are aligned to this change. And the another important thing which is coming the GST is new written GST system. The same is also applicable from 1st April 2020. Also, the first return will be get filed by in the month of May. But same as e-invoicing, a taxpayer needs to ensure that their IT system are very well ready and employees are trained to uh, know the intricacies of new return systems, and their vendors and customers are aligned to this change. The fourth and the last thing, as we are aware that old foreign trade policy of 2015 and 20, which is coming to the this end on 31st March 2020. The new policy will be announced by the government in 1st April 2020. So it is expected that the new incentive, the new foreign trade policy will have the WTA compliant incentive schemes. So, as you are aware, the new foreign trade policy prescribes various incentives to the taxpayers, like MEIS, SEIS, EPCG, Advance Authorization Scheme. So, as ROSTL scheme, which is currently applicable for the garment exporter, is likely to be extended to the all, and many of the existing export incentives are likely to go away. One of the important things which has come up from the recent news that Commerce and Industry Minister Piyush Goyal has said that SEIS scheme, government is thinking to done away with the SEIS schemes, as this scheme has not seen any positive impact on the exports of services.
So this is an important slide, and as Rohit rightly mentioned, that many changes are coming from 1st April 2020, starting with annual return for 2018. We know that for 17-18, the last date was initially 31st December 2018, but finally it got filed in January 2020 only. So as very less period has been left for 18-19, which is 31st March 20, it is likely that the government may defer it by 2-3 months. But yes, we'll have this clarity tomorrow. But yeah, this is one of the area you need to prepare, because even for 17-18 returns, it took a lot of time for the taxpayers to do all these reconciliations. E-invoicing and new GST returns, in our view, these are very fundamental changes and will affect the way you conduct your business. If you are not compliant with e-invoicing, either from IT readiness side or from operational side, your whole business will come to a standstill. Similarly, new GST returns, if you don't take credit on a real-time basis, then your cash flow will be significantly affected. But yes, again, there are news reports that e-invoicing may get deferred by 3 months tomorrow, and new GST returns will get deferred by 6 months. Lastly, on new foreign trade policy side, also MEIS, EPCG, drawback, etc. These are likely to go. So it will have a big bearing on your financials, because today export incentive is an extra income for you. It makes you cost competitive. Similarly, if SEIS scheme goes, it will be a big drain to the service export. So we need to watch out how this new foreign trade policy comes.
So moving on to the next section in the news and the current news which are buzzing around. So first is, recently Gujarat High Court has issued notices to department and government with respect to the denial of ITC on gifts. So it can be noted that Section 17(5)(h) of the CGST Act restricts credit on distribution of gifts and free samples. So a lot of companies in pharma and consumer goods industry are heavily engaged in this type of activities where they distribute gifts and free samples to their dealers and distributors. And due to this particular provision, they were not able to claim any ITC on the same. So companies has pleaded that the restriction against the ITC on free gift and sample is against the main objective of the GST, which is cascading of the tax impact. So it will be interesting to see how the Gujarat High Court will see this issue. And So second thing is, so uh,
So the next issue is relating to GST on license fees. So many of us are aware that whatever payments we make to government, be it like a factory license fee, ROC fee, etc., the reverse charge is applicable. So many of the taxpayers have challenged this levy on the ground that this is not a service at first place. The government is discharging its sovereign function only, so to that extent, GST should not be levied. In many of the cases, it is not creditable also, so it becomes a cost. So it's a very important issue coming up before the courts.
so the next news is the department has started issuing notice to the taxpayers for which for the to the taxpayer who has claimed ITC after the due date. So it is important to understand that for the year 2017-18, the last date of availing credit was a return of 31st March 2019, and for the financial year 2018-19, the last date for ITC availment was due date of filing return of September 2019. So department has now started issuing notice to the taxpayer who has claimed ITC after such due dates. So moving on to the next. So department wishes to impose GST on the value of global brands used by the Indian companies. So in India, there are many companies which are using global brand name or logo of their parent company, which is which the logo which is owned by the parent company outside India. So now GST department wishes to tax this transaction under GST in reverse charge.
With this, we come to today's edition of Roundup. And yeah, I think there were three people who raised their hands during the session, Nitin Nalnekar, Swati Goyal, and Ashwini Sharma. So please, if you have any questions, you can put in the panel and we'll be happy to answer that, or we can take them offline as well. With this, we come to end of our March edition of Roundup, and we once again thank you for joining in that larger number. So we'll get back to you with